Hey guys, Ryan Dash here, Dan Wurtele with the Vancouver Life Real Estate Group. Today we are going to be talking about, or more or less, it's a state of the union for Canadian real estate and a little 2022 forecast. Hey guys, if you're listening to this, it's likely and you're a realtor listening to this, sorry, it's likely the end of the year and you're in business planning mode. We would highly encourage you to reach out and find out how Dan and I doubled our business this year by joining EXP in the collaborative movement. The growth has been a result of receiving amazing coaching, lead gen strategies, and conversion techniques that would otherwise cost thousands of dollars. If you'd love to learn more, we'd love to chat with you. So please check out how to get in touch on the post below. All right, Dan, let's get into it. That being said, let's start off with home sales in October. Across the nation, they were 40% above the 10-year norms, which is insane. Canadian home sale volumes hit new all-time records for the entire year, with only 2 months left to go. The active listings have dropped 50%. 50% in the last 2 years. We have less than 100,000 active listings nationally, and home prices are up on average $150,000 year over year. Prices are at all-time highs. And I think something crazy to mention is that even if we had a correction in this market, a massive 20% correction, that's typically bigger than most corrections we see in the real estate marketplace in Canada. That would only put us back to September 2020 numbers, or 13 months. A bigger 30% correction would only put us back to March of 2019. Holy cow.
Yeah, quick recap. That's obviously national numbers there. We kind of talk and laugh about all times every week, every month, but they're still happening. I think the laughter largely comes from just how absurd it's become. You know, we deal with so many buyers that are so frustrated and so shocked at what is happening every single week, you know, especially when you're outbid by sometimes $50,000 or $100,000 on homes. It seems a bit detached from reality. And I think that's something that we can get into next here. When we talk about reality, we're talking about income versus price generally, right? That's kind of the biggest metric that people are going to look towards. And up to about the year 2000, about 22 years ago, house prices and disposable income percentages were largely aligned. In the States, that's still true today. The charts show that percentage of disposable income in homes are relatively the same. But in Canada, real home prices are now 3 times that of disposable income. So imagine going 40, 50 years and having this sort of metric that you could rely on, and all of a sudden it's 3 times that. And 3 times that's happened in only the last 21 and a half, 22 years here. So it's understandable that people are questioning what's going on and how has this really happened.
One thing I just want to add in there quick, Dan. Disposable incomes, yeah, that's a huge jump. The average rate of increase in wages since the 1970s has been 0.3% a year. That's the other crazy part. Anyways.
Yeah, no, appreciate that. Very, very relative and very important stat because, yeah, the average income growth is far below, obviously, housing rate growth, and something to consider and think about with your career choices, if you will. So both Canada and US home prices were very similar priced, respective of their local currencies, up to in and around 2005. But then since then, Canadian homes are now double the average USA home price, American price. Well, when you look at house prices as a multiple of per capita GDP, US homes are sitting at around 5.5 times, whereas Canada, we're 10.5 times GDP per capita. So you can understand just the correlation is just completely removed from reality in some senses here. There's a bit of a population note here that Ryan wants to touch on too.
Yeah, just in that time period, because, you know, I think it's interesting. Housing in Canada is such a direct result, I think, of supply and demand, but also monetary policy. So when you look at supply and demand, look at directly at population, in that time period from 2005 to present day, Canada is up roughly about 5 million people in population. It's gone up by 15%. And in the States, they've gone up by about 39 million, at least in terms of registered people. That's a rise of 13%. So, both countries are in and around growing at similar rates population wise. So, it kind of begs the question, why are Canadian homes going up at twice the rate, right? As American homes.
For sure. And of course, with these higher prices, when you have, again, detached from reality, if you will, prices, you got to pay for these somehow. And so back in the year 2000, up to that year, people were spending approximately 20% of their income, pre-tax income, on a mortgage payment. Today, that's upwards of 49 to 50%. Half of your income pre-tax is now going to mortgages. So you can understand the financial stresses there and where the risk lies. Because of course, people are going to pay their mortgage before they pay anything else outside of food. So when those payments become bigger, or when interest rates rise and when they have to refinance, what's going to happen? They're still going to make those payments, but it's the disposable income that disappears. It's the secondary markets that start to disappear, and it's all the sort of luxury items that are going to get hit first. So a bit of a precursor as to what might be coming down the road here. A quick note locally here, because it's just made headlines. Vancouver City Council just passed a 6.35% property tax increase, and people are up in arms over this huge number. Historically, I think the last 3 years have been in and around 5%, but I'm actually shocked it's not more. And the reason I'm saying that is you've got your average home is $1.2 million in Vancouver, and we've seen an increase in value of about $166,000 in just the last 12 months, right? That's your 2021 increase, $166,000 on average. The person has gained equity during that time. So what's that 6.35% property tax increase? Well, people pay about $5,000 a year on average for property taxes here. That's a $300 increase that people are paying. So let's keep in mind, the government essentially has done everything possible to make these these home prices increase in the last 12 months by $166,000, and they're only asking for $300 more in return. I think the average person, would take that deal all day long.
Yeah, to me, I completely agree, and I also don't think it's going to stop there. I think you could expect more. I think you should expect a lot more, considering what the country has just gone through. We might see all kinds of different taxes increase in the coming years, including capital gains and some other things that may get tabled later on. We got to pay for some of the stuff, right?
Yeah, totally agree. It's the easiest thing to do. It's just, let's just tax what exists already. It's the easiest stroke of a pen solution to add more money into the government coffers here. So yeah, I think Ryan's absolutely right. Expect more taxation, and I think they're going to lean on that too. The phrasing won't be exactly as blunt, but they're going to be like, look, we made you all house rich, so we're gonna take a little bit back for ourselves, if you will.
Yeah, totally. Income tax probably going to get looked at. Capital gains tax probably going to get looked at. If interest rate hikes come up, if they start to raise interest rates, you can expect your tax rate will probably go up a little bit too.
Just a stat that we pulled out. We're kind of rifling off stats here today because there's a lot to go through, but we felt that they were important to touch on. And we know in Vancouver here, GVRD, your average detached home is priced at $1.87 million. We don't talk about the Valley that often, but because this number is so big, we wanted to share it. The average detached home in Abbotsford is now $1.25 million. In January of 2020, not even 2 years ago, that was sub $800,000.
And I remember being in Abbotsford, bidding on homes that were in the $750,000 to $800,000 range. If you had told me then that those same homes could be $1.25 million, I would have laughed you off the block.
Yeah, 57% increase that is in just those 13 months.
Yeah, that's parabolic in a real estate sense.
Yeah, and part of the reason too, outside of everything that's happened here in the last 18 months, is we know that the detached home is disappearing. Um, when you look at just completions alone, what's being built right now, the vast majority is condos and purpose-built rentals. When you look at single-family home completions relative to population, back as far as 1955, that rate was about 0.65. Today, I mean, it's been a straight down chart. Today, there's only about a quarter percent, 0.25% of single family homes are being completed relative to population. So not only are they building less, but of course, they're tearing down way more and creating multifamily.
And I think that decline, if you were to actually look at a chart, is going to get steeper as well. I don't, we know, for example, the OCP plans here in Vancouver, 50% of all new construction are condos. That's 50%, right? 26% then fall into the townhome. The other, I think there's 20% fall into duplex, triplex, that kind of development. And I think it's only 6% of new construction is allocated for single family home. So, they're absolutely going away. And that's why people are paying tooth and nail for these things, because it's a scarce asset now. It's
Yeah,
going to be very, very hard to get in the future. Very hard to get.
I think if they know that data or not, I think you can feel it out there. You just sense that there's less and less detached homes, making it more and more of a valuable asset and more in demand. And of course, detached has seen the lion's share of appreciation over this last couple of decades.
Mhm.
And it's, again, like Ryan said, I think it's just going to accentuate because people are going to see that value more and more. And investors too, right? Investors look to those to say, okay, well, we're having more calls, more conversations right now about people going, well, I just want to hold a detached home or maybe suite it because I know it's only going to be X amount of time before the developers start knocking, and maybe there's that land assembly play or whatnot. But either way, they know that owning land is one of the best and safest investment plays right now. And
Always has been.
true, yeah, and it's I feel just increasing. And when it comes to investors, they are accounting for about 25% of all the new mortgages today. This is up about 9% in the last decade, right? It was only about 16% 10 years ago. So a huge amount of people are looking to invest right now, more so than they ever have. To the degree of something like 50% of the increase in home sales in the last decade has come from this group.
Wow. Wow.
Investors. And of course, a lot of them are tapping into their home equity to become investors. And when I say
Mhm.
investors, I'm talking about second, third, fourth property owners.
Yeah. I mean, they often get a bad rap too. Um, because they're the ones who are seen to be profiting from this, but they're also the ones that are putting out, higher levels of risk. They're remortgaging their homes so that, yes, they might be able to see that upside, but you know, the risk is significant. And on top of that, too, trying to provide additional housing for the rental market is something that comes as a result of this too, right? So, when you look at the government and you look at what they're trying to do, they open up and create monetary policy where they say spend, 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 spend. Investors are going to take advantage of that. It's just in their nature to do so. And now, sort of, we're in a position where they're accounting for a lot more mortgages. Um, but that's also part of the wealth divide. So if you've had homes over the last, decade, you've made significant wealth, enough likely that you can remortgage and keep going, right? The people who didn't buy a decade ago, it's now exceptionally more difficult to get in. And trust me, the decade going forward will be even more difficult. Anyways, that's a bit morbid, but
It is, unless you take that data and you do something with it.
that's right. Yeah, that's
Is
right.
my stance, because sure, you can look at what could be interpreted as morbid data, but you can also use that to your advantage.
You have
So
to. Yeah, you have to. It's,
yeah,
there's a lot of people. This is a bit of a holistic comment. A lot of people will try and change the rules of the game so that it benefits them. But the rules of the game have been this way for a long, long time. it would be my recommendation learning the rules of the game and trying to figure out how to play them to your advantage, as opposed to, trying to change the way that the game is played.
I think that echoes to what we've been saying the last 18 months or so of don't bet against the house. And the
Exactly.
house being Government Bank of Canada. When they show you that they're going to keep housing prices elevated, they've got the power to do so, and they've proved that. So if you're
Yeah.
thinking you can beat them, you can try. But again, the history shows that they're going to win every time.
And this is what the data says, right? When you look at, it was 16% a decade ago, 25% today. Well, what does that mean, right? That's more and more investors waking up, listening to the Bank of Canada, seeing what's happened in their own world and taking advantage of the system.
Mm-hmm.
That's what it is,
Yeah.
right?
Yeah. The Bank of Canada seems to be kind of exposing their realities more than I think they ever had. The last time, or sorry, at the beginning of the pandemic, when they said, we're going to keep rates pinned to the bottom, go make a big purchase, go invest. We promise we're going to keep rates low for a couple of years. And they have, right? I
Mm-hmm.
mean, pre-pandemic, when were they making 2-year predictions or statements?
Never.
Never, never.
Yeah.
And now they're even saying, hey, okay, yes, they're moving the goalpost a bit, but they're giving you a 4 to 6 month runway. That's incredible. As
Well, and
opposed to,
that's what,
surprise hike, surprise decrease. No, no, no. It's like, here's what's happening. Plan accordingly.
well, and that's why we've seen this sort of such a busy November, generally speaking, because, in 4 to 6 months, we know rates are on the way up. So if rates are on their way up in 4 to 6 months, we see a big push in November, October, and November. Is that really a surprise? No, that's people listening to the data that's coming their way, making decisions about it, right? So don't wait until it's too late to make that decision. Go now. And that's what they're doing.
Exactly. So let's talk a little bit further here about what's happening in mortgages. And right now, in the last 12 months, last year, new mortgages account for about $200 billion worth in Canada here. That rate is more than double what it was pre-pandemic. In 2019, it was sub 100 billion. This year, 2021, we are almost 200 billion. And what's happening too with rates is, we've got the fixed rate premium is at about 130 basis points above the variable rate. So understandably, most people, if you're going into the bank and you're talking to your lender and like, well, this rate's higher and this rate's lower, most people are going for what is currently lower, being variable. So much so that pre-pandemic 2019, about 5% of people chose to go variable. Today, that sits at 54%.
Wow.
That is a monumental shift in mortgage origination type.
Huh.
So
Interesting.
is there exposure there? Yes, of course there is. And this is an interesting topic and one we're going to expand on probably in late Q1, late Q2. So I was talking to our BMO contact this morning, and this gentleman has an immense amount of power with that bank and in the mortgage space. And yeah, so what happens? I've got a variable rate, interest rates rise, my payment stays the same. Big deal, right? Of course I can make those payments. Well, the risk is of course in the renewal when, let's say, it goes up to 3, 4, 5%, which I don't think is going to happen, but let's play extremes for this scenario. In that case, your principal pay downs are going down every single month if it's kind of a steady rise, if you will. And by the end of your term, let's say it's 5 years, well, you owe a bunch of money on your principal. And so your next payments are about to get a lot bigger. But what you can do, let's say interest rates start to rise. We know Canadians are flush with cash. So what happens? You utilize your prepayment options and you start increasing your payments directly towards principal. So it's a big conversation. There's lots of ways to prepare yourself if you are in variable and rates do start to rise. We're going to bring on our contact from BMO probably right around the first rate hike, which we can expect in April of next year. So look for that. But again, for right now, there's no reason to panic. There's always ways to stay solvent, especially with your housing.
It's interesting. Looking at that stat, Dan, tells me a lot. One, about how the behavior of people that are buying, the necessity at which people are buying, and the amount of risk that they're actually willing to take. Mm-hmm. It's actually, there's a lot of information in that big swing, which is crazy because that was only in 2019. where these things have changed, right? I
Yeah.
think the pandemic really kicked things in people's attitudes into a different direction, right? But 54% of new mortgages being variable, that's because, well, right now we know that there's about a percentage point difference between what you can get, probably more, 1.5% between a variable rate and a fixed 5-year rate, right? So it's a significant savings when you consider the fact that property prices have gone up 20+%. But what's also interesting about it is that people are willing to risk that rate going up um, on an asset class that is continually getting more expensive, going into an environment that is getting more expensive.
Mm-hmm.
It just shows me that the level of risk that people are prepared to take is a little bit higher than, not a little bit, a lot higher than where we were even just 2 years ago, right?
Absolutely. They're looking at what's happened in the last 2 years and said, oh my goodness, if I had bought then, how much equity would I have? They're just seeing things only go in one direction. So understandably, it feels like that can go on forever in a sense.
Well,
Now,
they do in Abbotsford.
so where was I going with this? So, oh yeah, so they're basically, we know that people, when they get a pre-approval, they know their top number. We know that upwards of 90% of people buy at their absolute top. And of course, by going variable today, they're trying to make their payment as low as possible. It is hard to get into this market if you have never been in it, and especially if you're not being gifted funds. So it's understandable people are just taking that risk because it feels like it's the only way in right now is to
Correct.
go to your limit, have a high risk level. We don't know the future. We don't know if rates are going up or when. So they're willing to take that risk just to get into this market where they're seeing 24% annualized returns, or
Yeah.
sorry, appreciation rates happen. So it's like, standing on the sidelines, it feels like you're just losing every month. And so getting into it, it feels less risky because of what, of course, the Bank of Canada has promised 2 years ago has become true.
Well, and you have to think, what's the bigger risk? Losing out on that 20%, or even let's call it 10% in a normal market, 7 to 10% gain, versus risking a 1% change in your monthly payments, right? That 1% monthly change in your payments can sting for sure, but it won't hurt like losing out on 20% over $1 million, right?
I think a lot of people are starting to look at it that way too. That's a great
Yeah.
point.
Yeah.
Again, people with money right now, if you can believe it, uninsured mortgages, meaning people that have 20% down or more, is increasing drastically. So much so they're up 19% year over year as of September. And this is part of the reason the CMHC is panicking, because less and less people are utilizing rather insured mortgages. So it just goes to show more people, like we've never been more expensive, but more people have 20% down than ever. It's a
Mm.
very polarized environment we are living in right now when it comes to the housing market nationally.
Yeah, especially when you consider incomes really haven't changed a whole bunch, right? It's just people are literally stretching more and more and more. And two, I think this is also a big the transfer of wealth if you do own property, right? If your family did buy a house at some point, right? Also, you got to look uninsured mortgages. Okay, so that's having 19, you know, up 19%. Well, I mean, a lot more people have a lot more cash this year than they did last year, through many different means. Um, the thing is people have more cash likely than they have. I don't know if they feel richer.
Well, I mean, let's talk about where consumers are, right? Like the savings nationally is incredible.
Yeah.
We're still seeing double-digit savings rates up to and including Q3 of this year, where nationally excess savings are sitting at $250 billion.
Woo.
That's 10% of GDP. And you look at all the countries globally, Canada is at the top. We have more excess savings in Canada than any other country per
That's such
capita.
a Canadian thing to say.
Yeah. So, understandably, insolvencies are 20-year low. So while, risks, interest rate hikes, these things are coming, all this savings is understandably going to soften the blow. So sure, you might start to see credit card payments lag. For example, you might see cars in the auto industry, those kind of investments start to lag, but people will always pay their housing first. So as as things become more unaffordable, I'm saying, within inflation, etc., housing is still going to get paid. It's the tertiary items that are going to start to get hurt first.
I agree with you completely. I guess where I say the statement, like, I'm not sure people feel richer. One, when you say that, okay, well, if interest rate hikes are coming, then all of those savings were up by 250 billion, as we said. A lot of those savings will then go away. So maybe they're not real savings at that point, right? If we have to dip into them just to pay for the things we're already in, we're not really using that towards generating more wealth. And then on top of that, too, I mean, you've got prices rising. I mean, the CPI is up by 4.7%. So things like gas and food and all of that kind of stuff feels more expensive. And trust me, I don't think you'll start to see those go down at any time. Once those hit new highs, they tend to stay there. And then you look at house prices that are up by, double the amount of savings, right? And savings, literally, as we've talked about before, for probably a lot of this year, is a function of inflation, right? So yeah, great, there's 250 billion more in excess savings, but we probably printed that, right? And we've, if you will, inflated our currency, or debased our currency by that amount. So yeah, people have more cash in their bank account, but things are so much more expensive to buy, you don't feel any richer, right? It looks better. Mm-hmm. But the long you look at the 2-3 year sort of way that the average Canadian is going to live, they might feel rich now, but that'll probably dissipate in the coming years.
I totally agree. So, lastly, let's touch on population growth, because we know that we need more bodies in the country to pay for more taxes and to keep housing elevated. As soon as population goes the other way, so does pricing. That's just a reality. So, where are we here? Understandably, during the pandemic, the world shut down, borders are closed, nobody's coming here. We're rebounding nationally off of the pandemic lows, but we're sitting at only about 1/3 of the 2019 population growth levels. Now, yes, we talk about PRs, permanent residents, being admitted into Canada at record rates. There were 45,000 last month alone.
Wow.
But the real growth is only at about 93,000 for Q3. Compare that to 180,000 in 2019. And of course, what's the discrepancy from? Well, a lot of these permanent residents already resided in Canada. They're just now permanent residents. So the rate of population growth is slow, but obviously we do expect this to increase, barring Omicrons and other variants, that are going to keep things shut down and whatnot.
Yeah.
But again, imagine what's going to happen when that does, if and when we get back to some sort of normal open border free travel world, and we start hitting those 2019 levels or the new targets that our government wants to hit. What happens then?
Yeah, it's a very good question. And to play devil's advocate, the other side of the equation is, if housing prices continue to go up too much, inflation takes over and becomes too much of an issue, it's going to become less and less appealing for people around the world to come to a place like Canada. So it's a double-edged sword. The government's got to be very careful with how they play this going forward. We can't have too much growth, because then people can't get in and build their own lives, which is what Canada used to be known for. Now it's becoming incredibly expensive. So, we need to see a huge boost in wages, or we need to see a big boost in income levels, I think, in order for that to maintain. Otherwise, I think we're going to be dealing with some, or there's just going to have to be other incentives that the government can, I'm sure, lever. But, things to think about for sure.
Yeah, so true. And okay, well, that's essentially the State of the Union. That's what's happening in Canada real estate in the year 2021. We want to get into some predictions, but you know what? We're going to save this for next week, because that was a lot to take in, and we really want to dig into the 2022 predictions, because I think a lot of people are paying attention. I think we're in a real transitionary time right now, and so people are going to have to make some big decisions next year, and we want to supply as much data and help and advice there as we can, because that's part of our role here. And we appreciate everybody listening, paying attention. Love your feedback. Thank you so much, as always, for watching. Dan and Ryan here with eXp Realty. We will see you next week.